evening, everyone. My name is Sandip Patodia. I'm an equity research analyst at Fundsmith Emerging Equities Trust. I'm here to give you a presentation or introduction to our trust and explain how we apply a disciplined approach to investing in emerging markets. Slightly different to the UK market that the last three investors have been covering. That's a disclaimer we are legally bound to show you. But if I can paraphrase what it's roughly saying, if you believe me what I'm saying, then it's your problem. Anyway, so I'm not sure how many of you are familiar with Fundsmith, so let me begin the presentation by giving you an introduction to our firm. Fundsmith was founded by Terry Smith in 2010. We run one equity strategy across 4 funds with total assets under management of around £18 billion. Our emerging market fund that we call FEET, which is what I'm here to talk about, currently has assets of around 300 million. In terms of our strategy, we have a very simple 3-step investment process. The first step is only invest in good companies. The second one is don't overpay, and the third one, and the most important step, is to do nothing. All the funds, the 2 funds at Fundsmith, the Global Equity Fund and the Emerging Market Trust is both run by Terry Smith. So why did we set up FEET? We set up FEET because there was demand from our existing investors in the Global Equity Fund to gain direct exposure to fast growth in emerging markets because of their attractive demographics and growing spending power of the middle class consumer over there. And we chose the investment trust structure because it gives us access to a permanent source of capital that allows us to implement a long-term strategy without being forced to sell our holdings at precisely the wrong time, which is what's happening to the markets right now. And from our global fund, as we got to know the companies in our global fund better, it became clear to us that their emerging market businesses, in most instances, offered higher returns and growth than their developed market parents. This gave us the conviction that we should consider investing in a broad range of consumer-focused emerging market businesses. On this slide, we show a comparison of revenue growth on the right and return on capital employed on the left in the global fund with their listed subsidiaries in emerging markets. Now, the emerging market subsidiaries are presented in red, and the developed markets companies are presented in grey here on this slide. But before I talk about the results, you may ask, why is return on capital employed important? I mean, because most investors in the global fund wanted to access higher growth. The reason we think return on capital employed is very important is because if you think about if you have a bank account, or if you take a loan from a bank at an interest rate of 10% to invest in a project, it's only worthwhile for you if you invest in a project that earns a return greater than 10%. And that's why we like companies that generate a return on capital employed higher than its cost of funds or cost of capital. I mean, growth is no good on its own. You know, any company can sell £20 notes for £18 all day long and achieve growth. So it needs to be value-enhancing growth. That's why it's important to have both returns and growth. And from this analysis, what we found is that not only the emerging market counterparts are growing at a much faster rate, but are also generating a return on capital employed higher than their developed market parents, which was very interesting. And this was also supported by forecast of consumption trends globally. As you can see from these charts, growth in the middle class spending over the next 15 years is expected to be largely driven by emerging markets, especially Asia Pacific, and of that, majority would be in China and India, which is of no surprise. So after establishing that an emerging market fund potentially makes sense, we started by looking at both multinational subsidiaries and their local competitors in the sectors we think includes a repository of high-quality companies. And the 2 sectors that we quite like are the consumer sector and the healthcare sector. And tobacco and alcohol is a subset of the consumer sector itself. So we started looking at the subsidiaries of these companies that we owned in the global fund in emerging markets and their local competitors in the market. We also found selectively good companies in the technology sector and niche industrial space. So to date, we've done in-depth analysis on about 200 companies in emerging markets, from which we have selected around 90 companies for our investable universe, or IU as we call it, which meet our very strict criteria. And we pick our portfolio from these 90-odd companies only. So let me now run you through our three-step investment process. The first one is only invest in good companies. So let me explain to you what we think a good company is. We think there are four main characteristics that define a good company. The first one is quality, which can be measured by calculating its return on capital employed, which I talked about earlier slide. The second one is growth, which a company's ability to continue growing its cash flows to achieve compounding. As I've mentioned to you, it's important to have both quality and growth, because a high-quality company but with no growth is nothing but a high-yielding bond. And a high-growth company with low quality is a value-destroying proposition. So after we've established that a company has very high returns on capital and has very good growth prospects, it's important that we can predict what the performance of these companies, what these companies can do in terms of business performance, and whether they can sustain these high returns and growth over the long term. I mean, if a company is doing very high returns and growth but can't sustain it over the long period and can get disrupted, there's no point owning it. We don't think that's a high-quality company for us. So to ensure we can predict a company's performance, we look for companies that tend to make money from a large number of everyday small-ticket, repeat predictable transactions. As I said, we are not in the business of trying to predict we are in the business of trying to predict the business performance of the company and not its share price. In theory, the share price should follow the performance of the company. And lastly, we spend most of our time in research trying to understand why a company may be able to sustain its high return and growth. And we call this a company's sustainable competitive advantage. There are several sources of competitive advantage that a company may have, including consumer brands, distribution power, regulation, intellectual property, etc., that makes these businesses very resilient to change. And you might notice that that management assessment is missing from this slide. And the reason for that is we think it's hard enough trying to assess a company. It's harder to assess management because it's difficult to assess humans generally versus assessing a company. And therefore, we'd rather invest in a business. Although we like businesses that has good management, we'd rather invest in a business that an idiot can run, because sooner or later one runs it. So over the next two slides, I'll try and explain why some of our companies in the portfolio are able to sustain their high returns and growth. On this slide, we show you examples of companies we own on our portfolio and the main source of their competitive advantage that allows them to sustain and generate a high return on capital. So for example, Asian Paints here, the main advantage is their distribution. I mean, they have 65,000 dealers in India, which is 3 times its nearest competitor. It will take 20 years for another company to replicate that. So that's the sort of competitive advantage that they have. Maybe another example, Marico, which has its brand. It is an Indian personal care company that sells hair oil in the Indian market. And I don't know if you guys know, hair oiling is an inherent part of the Indian culture. Marico, through its Parachute brand, which is the blue bottle here, controls about 65% of the coconut hair oil market in the country. The second largest maybe has a market share of 5%, so it's pretty dominant. Roughly 3 years ago, the raw material prices of coconut hair oil went up by 60%. So just to offset that increase, the company had to increase the prices of its product by 40%. And despite that, the company delivered high single-digit volume growth. Now, why is that important? That tells us that coconut hair oil, and this brand in particular, is more price inelastic than tobacco. And that's the sort of pricing power we look for in companies that we assess. Maybe I'll give you another example. On the middle right of this slide, the oval logo is an Egyptian tobacco manufacturer called Eastern Company. Eastern is the only company allowed to manufacture and sell tobacco in Egypt, which is one of the very few countries in the world where tobacco consumption is actually going up. Further, the Egyptian government holds a majority stake in the company, which makes the company effectively a government-mandated monopoly selling an addictive product in a growing market. On this slide, we show you examples of trends that allows our companies to sustain their high growth over the very long term. In the previous one, I explained to you the quality aspect, but it's no point having quality if growth is not there, because the returns wouldn't compound. So for example, on this slide, maybe Chinese travel, Travel Sky is a company on the bottom right. It's a technology company in China with a large install base of customers. It has a virtual monopoly in processing transactions for China's airline ticket booking system, and has a market share of 99%. So it's a virtual monopoly. And the Chinese travel is effectively a well-established growth trend. The market is growing in excess of 10% and is expected to continue doing so for the foreseeable future. So Travel Sky allows us to take advantage of this trend without worrying about competition eating away its high margins, returns, or growth. It's basically a utility without any price control. Another example on this slide is the yellow logo called Dr. Lal Path Labs. It is the largest player in the $9 billion Indian diagnostics market. Dr. Lal provides pathology tests by collecting blood and other samples from patients and reports diagnostic information for doctors to assess the patient. It offers major growth over the long term because of increasing per capita spending on healthcare in India and significant increase in lifestyle-related diseases like diabetes, hypertension, and obesity. That's because all the American brands are being transported across to the country in the form of Domino's and McDonald's. And on top of that, the formal industry in India in terms of diagnostics is just 25%. The rest of it's controlled by informal players, and therefore there's huge amounts of scope to gain market share from the informal sector as the economy formalizes. And this is evidenced by the fact that this company has been able to grow its business at an annualized rate of 18%, yet sustain a return on capital of more than 50% for the last 5 years. 50% return on capital compared to cost of capital in the country at 12%. Imagine you getting a loan of 10% at a rate of 10% and investing in a business that earns a return of 50%. That's the sort of business that we're looking at. So now I'm going to explain the second leg of our strategy, which is about the price we're willing to pay to own good companies. The order of our investment process is not an accident. We think most people start with evaluation and then look at companies. We think that it's important to look at the companies first and then look at valuation. And that's why we talk about valuation after that. This is a rather busy slide, but let me try and explain. On this slide, we have presented the operating metrics of our portfolio companies by consolidating them as if the fund was a company. FEAT numbers are presented on the left here, and we show the metrics of the emerging market index in the middle, and we show the global fund on the right. You can see that FEAT generates an overall return on capital of about 47%, which is 3 times that of the index at 15%. And FEAT companies also generate a much higher gross margin and operating margin compared to the index. And they have a cash conversion ratio of 110% versus 86% for the index. What does cash conversion mean? This means that our companies convert £1 of earnings into £1.10 of cash flow compared to 86 pence for the index. In terms of growth, FEAT companies are growing at a rate of 16% compared to 30% for the index. And remember, in index, the emerging market index has companies like Tencent and Alibaba of this world, which are growing at a rate of more than 40%. But when I think of Alibaba, 40 thieves come to mind. That's why we don't touch that company. We also think that the growth of our companies are more sustainable versus the index. And with regards to company valuation, instead of looking at PE ratings, which most investors do, we look at cash flow yield, because we think whilst earnings can be manipulated, it is almost impossible to manipulate cash flows. And that's reflected in the cash flow conversion ratio here. There's a 20% difference between the cash conversion, the earnings, and the cash flows here. So what does the valuation tell us? So in terms of cash flow yield, FEAT is almost 1.5 times more expensive than the index, at 3.5% versus 5.3% for the index. Now, there's a common misconception amongst investors that a high PE means expensive, and low PE means cheap. We think expensive and cheap is dependent on what you get in return for what you pay. What I mean by that is, although you're paying 1.5 times more for feet versus the index, but what you get in return is 3 times the return on capital employed and 20 to 30% higher growth, which, by the way, we think is more sustainable. So we think it's actually, feet offers much better value than the index itself. So to demonstrate why we think assessing companies should come before looking at valuation, we did some analysis on the S&P 500 index. What this chart shows you that if you were able to time the market perfectly in the last 100 years by buying the S&P 500 at its lowest P in 1917 at 5.3x, and you were able to sell it at its highest P at 34x in 1999 at the time of the dot-com bubble, 80% of your returns would have still come from earnings growth, and only 20% would have come from re-rating, or your amazing market timing over the last 100 years. So that's why we think even if we can spend 80% of our time assessing companies and 20% of our time looking at valuation, we'll do a good result. So now I'll explain you the third and the most important part of our strategy, which is to do nothing. Why is doing nothing important? Because as a fund manager, he comes into his job every day in the morning. He thinks, oh, I have to do something. I have to buy and I have to sell something. And that's what creates problems. That's why doing nothing is very important. Doing nothing means avoiding activity. Once we have identified and bought good companies, and that's why at Fundsmith we do not engage in market timing. So to illustrate this point, we assumed an investment of £10,000 in S&P 500 for 15 years, from 2002 until 2017. We chose this period because it covers a full economic cycle, including the financial crisis of 2008 and 9. What this analysis shows you is that being fully invested for 15 years would have given you a total return of 351% and a compounded annual return of 11%. However, if you miss the best 20 days in the market, the total return declines to less than half at 135% and an annual compounded return of less than a quarter at just 2%. We also found that the best days in the market were often the days after the worst days, which makes it almost impossible to time the market. We think there are 2 types of investors: ones who do not know that they can't time the market, and ones who know they can't time the market. We're definitely in the latter camp. So let's now look at when we tend to sell a holding in the portfolio. We invest in a company with the intention of owning it forever. However, sometimes we have to exit a position when management makes a bad capital allocation decision. Typically in emerging markets, this happens when a company wants to expand into developed markets. That's a recipe for disaster. We have to sometimes also exit a position because we have misjudged the company's ability to sustain its returns or growth. We are usually reticent to sell a company for valuation reasons, but we'll do so if the cash flow yield becomes indefensible, i.e. if what you're getting in return for the yield is not sufficient to justify the valuation. Finally, we own good companies, but we sometimes have to sell because our companies get taken over. We will, however, not sell in response to a general market sell-off if the company fundamentals remain strong. To put this into context, our annual turnover rate in the first half of 2018 was around 12%, and we expect this to decline further to perhaps less than 10%. Let's now look at how our fund has done since launch in 2014. On this slide, we have compared our fund performance against the Emerging Markets Index. We have to do so because of market practice. Strictly speaking, we think our fund should not be compared to the index because we run money on an index agnostic basis, which is evidenced by the fact that we only own 0.8% of the index in our portfolio. Our active share is very, very high at 99.2%. Anyhow, you can see on the slide that we've delivered an annual growth of around 4% versus 9% for the index since inception 2014. Even as we believe that our performance should not be compared to the index, given the investment community looks at comparative numbers, I'll attempt to explain the reasons for the divergence in this performance. On this slide, the red highlighted sectors are where we invest in healthcare and consumer staples. We selectively invest in IT and consumer discretionary. In summary, we're very different to the index in terms of the sectors that we invest in. don't invest in banks, airlines, real estate, oil, mining, utilities, telecom, and high technology companies. And together, these account for around 80% of the emerging markets index. And therefore, our performance would differ from the index from time to time. On this slide, we show you our fund's country exposure on the left and the exposure of the index on the right. Again, you will see that we are very different to the index. Our exposure to countries, including 40% allocation to India, is an outcome of investing in the best companies available across emerging markets. We did not set out to invest 40% of the fund into India, or 16% into China, or 8% into Egypt. This is just an outcome of where we found the best quality or the highest quality companies globally. You'll also notice that we don't have any exposure to South Korea and Taiwan, which is about 25% of the index. We think South Korea and Taiwan are actually developed markets because their GDP per capita is actually comparable to Spain. And therefore, we've taken that out. That's 25% of the index. We have underweight China massively. And that's because our investment into China is mainly led by Hong Kong-listed companies because there's a dearth of high-quality companies in China. And the disclosure standards, the corporate governance standards, are abysmal at best. And given our country exposure versus the index, we've seen a negative relative performance of 18 to 20% on account of currency because Hong Kong dollar is pegged to the US dollar and South Korean won and Taiwanese dollar have both outperformed other currencies, emerging market currencies. So that explains the bulk of the underperformance. Finally, as you can see on this slide, with more than 50 billion of outflows from active funds into index and ETF funds since 2015, most of the incremental investment into emerging markets has gone into index-heavy names, which we have zero exposure to. Therefore, we think our fund has underperformed the index in the short term because of a very high active share, major difference in currency exposures, and fund flows into index-heavy names. However, we will not be changing our strategy just to perform in line with the index in the short term, and we'll continue to invest in good quality companies. We think the share price in the long term will reflect the superior fundamentals of the companies we own. As Benjamin Graham and Warren Buffett often said, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. The quality of our companies may or may not get recognized in their relative share prices in the short term, but we think it is inevitable in the long term.